Welcome to Biz Money Insights and Strategies. My name is Vanessa. I'm a CPA and I help everyday entrepreneurs understand financials so that they can make better business decisions. So, today's lesson is all about the balance sheet, what you own, what you owe, and what your business is actually worth. So, let's get into it. This lesson is specifically designed for coach freelancers and online service providers. However, the core financial principles apply to all businesses. What you'll learn today, the core formula of the balance sheet, why are lenders and investors interested in the balance sheet, what are the three simple tests to check for the financial health of your business, and what are the red flags to watch out for. Let's get into it. So, what is the balance sheet? The balance sheet essentially is a snapshot of your business worth at a certain point in time. So the balance sheet shows what you own, which is your assets, what you owe, your liabilities, and whatever is left, that's your equity. So the balance sheet equation is assets equals a liability plus equity. That equation should always balance. The house is the asset worth about $100,000. The mortgage is a liability around $70,000, and whatever is left is the home equity, which would be $30,000. So it's similar to your business, what the business owns, asset, what it owes, the liability, and whatever is left is the equity. So you have the formulas here, two ways: equity equal asset minus liability, where assets equals liability, equity. All right, now why the balance sheet matters. This is one of the reports I feel like is sometimes overlooked by the business owners. They tend to focus mostly on the P&L. So why is the balance sheet important? It's an important report for the lenders because before they can fund you, they need to see your balance sheet. Essentially, what they're looking for is, do you have enough assets to cover your liabilities? So in case of non-payment, can they seize your asset and liquidate them to pay for your obligations? The next group of people who are interested in the balance sheet are going to be your investors. Your investors are checking for growing equity. They're not just looking at today's profit, but they're trying to see if the business is building a long-term value. So a strong growing equity section is very important to investors. And lastly, for you as a business owner, why is the balance sheet important? So as the CEO of your business, the balance sheet shows you can handle a slow season, right? Do you have enough assets to handle a slow season? Or is your balance sheet highly leveraged, meaning that you have way more debt than you have asset? So your balance sheet really showcases the stability of the business, right? Can you handle a slow season? Remember, your cash is also sitting on your balance sheet. So the balance sheet allows you as a business owner to gauge, do you have enough resources? By this meaning your asset and your equity. Your sales create momentums. Your sales are important. Sales are the starting point. You cannot have a business without sales, but your balance sheet is really what showcases if that momentum is sustainable. So what counts as assets, liabilities, and equity? So asset is basically anything of value that you own. So these are your valuable resources of your business. So here we would have cash, prepaid expense for the service providers. A prepaid expense could be some of those subscriptions, because a lot of the subscriptions require you to pay annually upfront. You should be expensing it every month because it covers the entire year. So every month you should be expensing 1/12 of that asset. So the remainder of that subscription prepayment, if you're using the accrual, is considered an asset. Your equipment and computers, your accounts receivable, which is money owed by the customers for services that are already delivered, and then the liabilities, or essentially what the business owes, the obligations of the business that they still have to pay. So it's pretty self-explanatory. And then you have the equity. The equity is essentially what's paid after all your bills are paid. So the owner's capital is technically your initial contribution when you started the business. The retained earnings are basically all the past earnings that are still in the business, that are retained in the business, hence the name. So this is the makeup of the equity. And then the last category would be any investment in the business. All right. So now let's talk about financial fitness, right? So the very first indicator that we're going to learn today is the current ratio. So the current ratio helps you understand if your business can cover its short-term bills. So your short-term bills are basically any liabilities that you have that is due within a year. So the formula for the current ratios or your current assets, so these would be your cash, your accounts receivable, any inventory that you plan to sell soon. So these would be your highly liquid assets. And your current liabilities or all the debt that are due within 1 year. So these would be your credit cards, any upcoming loan payments. If this ratio is over 1, it indicates that the business has the ability to pay their short-term debt. But if the ratio is under 1, the business has more liabilities than assets. So in this example below, you have $12,000 in cash, you owe $15,000. The concept behind this is if your short-term bills were to be due tomorrow, do you have enough assets to liquidate to cover them? And in this example, the answer is no. So now let's move on to the second financial indicator. This would be debt to equity ratio. So the debt to equity ratio essentially shows how your business is being funded. So how much of your business comes from debt and how much comes from equity. So a ratio under 1 means that your business is balanced, right? It's balance between owner funding and debt. And a ratio that is over 2 indicates that your business is highly leveraged. You have more debt than you have equity. And it's considered higher risk by lenders. And last financial fitness indicator number 3 is a positive retained earning. So the retained earnings is exactly what it sounds like. It's all the earnings that are retained in the business. So it's the profit that the owner did not spend. So when you have a higher return earning, it means that you are reinvesting in the business. Is what's left after you've paid yourself any distribution, any expenses. So a positive retained earning is a good indication you're building equity in the business. But if that number is negative, it indicates that you've had a lot of losses or high owner withdrawal. So we're not here to just make money. We should also reinvest money in the business in order to improve scaling and growing. Now, what are a few warning signs for the balance sheet? The first one is a negative equity. Essentially, it's saying that you owe more than you own. Your liabilities are greater than your assets. Number 2 is balloon payments. If you have any balloon payments that is coming due soon, any large payment that can hit pretty soon, it can put pressure on the balance sheet. And slow moving inventory. So any time you have slow moving inventory is tying up your cashes. And last red flag is no cash reserve. So Similar to personal finance, a business also needs to have cash reserves, savings, and emergencies for unexpected expenses. What are the 3 quick tips? The first one would be to start building an emergency fund to have a reserve in cash for the business. Number 2, do not spend every lump sum. Whenever you receive any sort of lump sum, please keep in mind that you do have to pay tax on these lump sum. You should set money aside for your taxes. And last tip is to learn to read your balance sheet every month. Homework. So pull your latest balance sheet, calculate your current ratio, your debt to equity ratio, and check your retained earnings, and just identify one red flag to fix. Now, here are top takeaways for this lesson. So your balance sheet is what indicates how stable your business is. How can you weather the storm? The balance sheet is the foundation of your business. It indicates stability. It builds trust with the lenders. It's also really good to know your ratios and to keep track of these financial indicators that we just went over, right? Because it really gives you a good insight as to how your business is doing and what are the areas that you can be proactively working on. All right, so when you know your numbers, you lead with clarity. Disclaimer, this content is for educational purposes only. It isn't financial, tax, or legal advice. Always consult a qualified financial professional for guidance specific to your situation. And that's it for today's lesson. I hope it gave you more clarity, more confidence with your numbers. Today was lesson 4. If this lesson was helpful to you, please consider subscribing, liking, and sharing with a fellow business owner. I appreciate you for watching. Thank you again. This is Vanessa, CPA, founder of BizMoney Insights and Strategies. I will see you in the next lesson. Take care. Bye.